It looks like analysts have downgraded Best Buy as they feel as though other purchases by consumers will be more prioritized during the Christmas and holiday season. However, is this one of those classic opportunities where a stock is being ignored by the street, a la Peter Lynch type investment opportunities that we can pick up on the cheap? That's what I'm going to investigate in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And this one's very interesting because I was reading an article on Barron's. You guys know that I love reading the Wall Street Journal, Barron's, or anywhere else that I can get securities news. And I noticed that an analyst actually downgraded Best Buy. Now, I love when analysts downgrade stocks that I like, especially companies that I really am into that I don't currently hold in the portfolio. And so anytime I see a downgrade, it's music to my ears. And so let's dive into this one and see exactly what's going on. And then I'll give you a valuation and certain option types opportunities that exist on Best Buy. Okay, let's jump right into this article. So you can see here, it says that Best Buy was downgraded as needs are expected to be prioritized over wants this holiday season. However, this reads very much like a short-term focused decline caused essentially in the stock by an analyst where, and notice that the stock was down almost 4%, where, you know, here's where value investors can really pick up gems. And that's what I'm saying here on sale, as we rather focus on the long-term intrinsic value of a stock as opposed to the next 12-month valuation based on industry multiples. And what do I mean by that? Well, in my comments, oftentimes there's people that will say, hey, your multiple should reflect something. So it should reflect the industry multiple or whatever. And to that I say, my multiple can reflect whatever I want it to reflect. And so if I just want it to reflect the perspective that this is what my intrinsic long-term multiple that I'm going to put on the company, essentially 15 times earnings for, 15 to 20 times earnings for most companies, I'm the buyer. I have the right to do that. And so I think one of the things that people conflate is they look at industry analysts and they look at the way that they value companies. And, there's nothing wrong with the way that they value companies, but because they focus on throwing a multiple on the next 12 months earnings, they're going to miss the bigger picture. And that's where, you'll see that analysts will typically follow a stock down or up because they're essentially just following the next 12 months earnings as they deteriorate or they accelerate. And so that's why you see, if you ever look at charts of analysts' calls, it's generally following the share price. That's what's happening there. But as people that focus on intrinsic value, we really don't have that. And so that's why I actually have the tracker that the Patreons get access to. And if you look at the tracker, generally the stock price is moving all over the place, but the long-term intrinsic value of the company remains pretty steady over time. And the point of that is so that we have some sort of stability, something to look at when you see this volatility in the share price. And that's kind of what we're seeing here. And that essentially reflects what many value investors do. And so it's a little bit different from the way that Wall Street analyzes companies. And I also think it's a better way. It's how I allocate capital in my portfolio personally. Now, just going back to this article. So they're saying that consumers will be prioritizing buying items that they need this holiday season rather than what they might want. And so essentially Elizabeth Suzuki downgraded her 12-month price target. Remember, I just did that whole rant on these 12-month targets on the stock to $69, nice, from $80. And so Suzuki wrote in a research note on Wednesday, this came out a couple of weeks ago, December 14th, that spending has been weak for consumer electronics and it won't get any better as the future of the economy and possible recession remain unclear. Perfect. So it looks like there is pessimism in this name. The analysts are starting to get a little bit bearish on it. Now my sort of like spidey senses are heightened. I'm watching Best Buy and I'm going to be greedy at the price point that I get into it. But let me dive more into the analysis right here. So the article goes on to say that the Bank of America has been tracking spending throughout the holiday season and found that consumer electronics and hobby retail spending specifically declined more than 13% year over year. And Suzuki expects that 2023 to be another year where consumer spending is prioritized over towards needs like fuel, maintenance, repairs, all that stuff, and away from wants. And so of course that wouldn't be good for Best Buy, which seems, which makes its money from selling gaming systems, computers, and televisions. However, a medium-term pullback in discretionary retail presents a headwind to both sales growth and valuation. And so that's kind of what she's saying. But once again, when you look at it from a long-term perspective, does it really matter what happens in 2023 and the remainder of 2022? I don't think so. It's just 2 years. I mean, they have a impact on the ultimate valuation, but it's not everything. And so she goes on to say that she's lowered her estimate for 2024 to $6.90 per share, and I'll compare that to my estimate in this video, and then in 2025 to $7.92 per share. I actually think, despite being pessimistic on 2023, she's more optimistic on 2024 and 2025 than I am, and I'm excited for this opportunity, which is very interesting. And so let's dive a little bit into this. So essentially what I'm doing is I'm saying that revenue is expected to decline by at least 10% in 2023, no recovery in 2024, and then just small recoveries thereafter. And so I am much lower than the street in my estimations for, or in my estimates for revenue, which of course flows to the bottom line. So of course, I just put this note in here just to remind myself that I am coming under what Wall Street's coming under. And it's interesting that Wall Street, just based on the language that they're using, they seem to be more pessimistic on this name than I am. And so here's the bottom line. You can see that I'm forecasting $6.50 for 2023, and I'm forecasting $6.50 for 2024. Recall guys, that the analyst had $6.90 for 2024, and then she's into the $7 in 2025. So I'm much more pessimistic on this name than they are in terms of how I'm valuing it. But despite that, notice how high the equity yield is, right? And the equity yield is just the earnings per share divided by the current share price. And the idea there is that, you pay once for the company, and you kind of just look at it like a bond. It just pays you a certain amount every year. And so that's what the equity yield is. And I'll make more sense of that equity yield in the next slide. But essentially, you see you got this $8.15 equity yield security, and it's increasing as time goes on. It's like, in the medium term, it automatically turns into a close to 10% equity yielder if the earnings just grow by 5% a year beyond 2025. And so, you can see very quickly that it turns into a 10%er. But guys, just because a company has a strong equity yield, or at least on paper it looks like it has an equity yield, doesn't necessarily mean that that money goes back to the shareholders. One area could be that they could have a lot of stock-based compensation, and so they might be buying back a lot of shares, but those shares are just going back to buy back shares that they issued to management. So that means that equity earnings that you're generating are not actually flowing to you. And so what you would have to do is you'd have to do a free cash flow per share valuation and adjust out stock-based compensation. And if you want to know how to do that, take a look at the Alibaba model that I did. I build that in because Alibaba does have high stock-based compensation. The second area where you could lose the money and it doesn't come back to you as an equity yield is they continuously invest in CapEx into the business, but it's not generating a high return. So the one way to sort of catch that is over time, do you see that return on invested capital or the return on equity tick down? And so that effectively means that they're deploying capital inefficiently and thus effectively wasting your money. And so I want to just show you Best Buy's cash flow statement just to give you an idea of how you're generating this equity yield. So you can see here that the significant majority of the generated equity yield is being paid out through share repurchases and the issuance of dividends. And so notice how low the stock-based compensation here is as a percentage of free cash flow. So they're not diluting you as equity shareholders. I don't like this 13 and 16% back in 2013 and 2014, but and the 15% in 2016. And so I hope that this remains low. It has remained low over the last 5 years, and so let's make sure that it stays that way. And so based on what I see here in the cash flow statement, this is a very shareholder-friendly organization based on the fact that they're effectively paying out all of that free cash flow that they're generating by buying back stocks or paying dividends, or even, I even like the fact when a company's paying down debt, it will impact the valuation because I penalize valuations based on debt that the companies have. And so if you just use your excess cash to pay down debt, it doesn't diminish your valuation in any way. And so that's good as well. There is a little bit going into CapEx, as you can see here. And so the next analysis that you'd have to do is how is return on equity trending over the last 10 years. But just generally with retailers, the ROE or return on invested capital is probably the better metric. Generally with retailers, return on invested capital is pretty high. And so I think that this is a very shareholder-friendly organization and a strong staple in a long-term focused portfolio. But ultimately, it comes down to what is the valuation. Now, before I get into the valuation, I just got to remind you guys that approximately 80% of the watch time on this channel is coming from people that are not subscribed. So if you have the opportunity, hit that subscribe button. And also, if you want to get access to the models, you can get access to all of my models, including the Alibaba model, including the Tencent model, Microsoft, Apple, everything at that lower tier of the Patreon, which is just $5 a month, which is effectively just you buying me a couple of coffees to get access to all my research. Now, guys, let's dive right into that Best Buy valuation. So you can see here that although it's currently trading at approximately $80 per share, I think it's a great price, but I've become extremely selective going into 2023. And so I'm going to remain patient on this one and pass on buying the shares for now. But the only reason why I'm doing that is because I have 5 or 6 opportunities right now that I'm looking at that are better than this. And so as I deploy my capital into 2023, I'm just deploying it into those better opportunities right now. I'm not purchasing the shares of Best Buy. However, in this video, I'm going to show you why there is one opportunity for Best Buy which does make sense utilizing options. So let's dive into that. So you can see here, these are the cash secured puts for January 19, 2024. You can select any exercise term that you would like. I like long dated terms, but that's just my preference. And so let's look at the yields on these cash secured puts using that free downloadable cash secured put calculator. Now, you can get that from the description in this video. It's a free downloadable calculator. I think it really helps you guys understand the relationship between premiums, exercise prices, and the different types of options, whether it be cash secured puts or covered calls, which are generally the only options that I play with. Now, with Activision, I did use a different type of option strategy, but for most of you guys, I just don't think you should be using many option strategy. In fact, I always say the best strategy is just to buy and hold the share. So buy low, sell high. Don't play the options game. Just crazy people like myself, we like to do it. And I call myself a crazy person, but you can really see how you can actually significantly reduce your risk by selling cash secured puts. So here's an example. So you can either get the 8% equity yield by just buying the shares at the current share price, or you can get that same 8% annualized equity yield by selling the $60 cash secured put, which of course would give you a much higher equity yield if exercised, because they'll just be generating the same earnings per share and your cost basis would be $54.80, or you can consider your cost basis $60, however you want to look at it. But of course, with a $60 per share price, you have taken out a lot of risk in this security than you would have entered into had you bought it at that $80 per share. So this is an example of how cash secured puts used correctly by value investors could actually reduce the risk considerably. And remember, my valuation is $113 per share. So a $54 per share net purchase price, which is just the $60 less the premium, gives you a 48% net price to intrinsic value. So that's a huge margin of safety. So this is one of those examples where you can significantly reduce your risk with a selling a cash secured put. And of course, you have to sell these in batches of 100. So that $60 would have to reflect $6,000, because it'd be 60 times 100. Now let's take a look at the next cash secured put. So you can see here the $70 strike price cash secured put will give you a premium of $8.50. That gives you a nice healthy annualized 11% yield, and you get a net purchase price of $61. So this is once again not bad, and it reflects 55% of its intrinsic value. So once again, not a bad option. You get your double digits of annualized yield. So I really like this one as well. And then going into the last cash secured put, this is the $80 strike price cash secured put, and the current share price is approximately that. However, it gives you a much higher yield, but if you don't get exercise on it and the share price runs, it's a one-time type yield. Now, some people do say that over the long term, you just make less money because you get the one-time hit. But, over the long term, you're getting that 8% every year, and the 8% is growing. And I would say you're absolutely right. This is why it's better to just buy shares and hold shares instead of playing in the options game. But, with this, you get a net purchase price of $67, which is just at 80 minus the 13. So if you are exercised, you own the stock at approximately 60% of its intrinsic value. value, as opposed to around 70%, which is the current share price. I mean, at the end of the day, whether you buy it at $70 or $80, just compared to the valuation, I think it really doesn't matter. Now, some of you guys do like for me to look at the covered call opportunities as well, so I'm going to use the same exercise date and just look at the in the money or at the money covered call, which is at $80. You notice that it's got a much higher premium than the cash secured put, so you know the yield is going to be higher. And so you can see here, this is the covered call calculator that once again you guys all have access to in the description. And so you know, there's the date, there's the strike price, there's the premium, $14.50. And if I'm patient, I can probably get a higher premium than $14.50, but let's just put it at that right now. Notice that you get a 16.25% annualized yield, and your cost base is about $1 lower than the at the money cash secured put. And so the covered call gives you a lower cost basis and a higher current yield, and of course annualized yield. This one might be the one for me. So if I'm looking to enter Best Buy, this might be the way that I do it. Of course, with covered calls, you have to buy the shares and then you have to sell a covered call. It's not the most like effective way of buying and owning this security. Once again, I've said it a couple of times, the best way is just to buy the stock. It's a great company. They're operating well. Yeah, they're going to experience some headwinds over the medium term, but over the long term, this name is great. But once again, none of this is recommendations to own the stock. What I really like to do is just show you how sort of like a professional investor, or I guess like a formerly professional investor, would sort of like look at these types of opportunities and how I sort of look at them, how I model them, how I look at sort of like opportunities to invest in them based on what's being reported in the news. And so that's kind of what I wanted to get across to you guys in this video. Now, another piece of news that's very interesting right now is that it looks like there's a bipartisan bill that's looking to ban TikTok. And so what does that mean for Meta's shares? Because once again, Meta competes with TikTok through their Reels product. And so I actually broke that whole situation down, which you can get to right here.